finishing up this question about
Yeah.
this person who has 36 months off from 36 left. Wow. In 36 months, they will
That's
pay off
easy
their
for
house.
you to say.
And they want to understand the process of what it would take to remortgage that house, buy land, and build a house.
Okay. Congrats on having your house, 3 years from being paid off. You don't have to wait till it's paid off, though. I don't know if they're feeling like they got to wait till it's paid off to remortgage it. You can do what's called a cash out refinance now, and it will take whatever balance you have left to pay. It'll roll that into the new mortgage, and that'll get paid at closing. And then you can take out up to 80% of the equity of your property as determined, usually by an appraisal. Not always, though. We can get an appraisal waiver sometimes when we put it into the FAnnie Mae or Freddie Mac system. If it likes the value that we give it and they have enough data there from other home values, then it will give an appraisal waiver. And in that case, you wouldn't need one. Then we just go by whatever up to 80% of the value. So you could buy the land outright. If you have enough equity, you could also finance the construction of it yourself if you had a private builder, which is really that's one of the least expensive ways to do it. But you can also look at doing a construction to perm loan. We don't have them back yet. They kind of went away during COVID, but I'm expecting that that's something that should be back within the next 2 to 3 months. From what I'm hearing, we're hearing some rumblings that a couple of the investors that we do that with are coming back into the ring, so to speak. So we may be able to start doing those construction to perm loans. And what that means is that you borrow the money to pay for the various draws. When you build a house, you build it in sections, you build it in draws. So like the first would be preparing the land, getting it leveled, getting it built up if it needs to be built up, putting in the essentials, the electric, the plumbing, the driveway, the what do you call that? The foundation, the basics. So that may be your first draw, pays for all of that. And then once that's done, then they'll have an inspection, say, yep, that's done. And then they give you the draw for the second phase of the construction and so on. So you can borrow that money and you do pay interest on it. Each time you do one of those draws, you start paying interest on it, but it's an interest only payment. And then later, when everything's finished, you convert that into a normal fixed 30-year loan or 20-year loan or whatever it is that you want your payments to be. But the first part is getting doing that loan to get the equity out of it. And I wonder what they're going to do. I wonder if they're going to sell it later or if they're going to keep it.
Yeah, I'm curious.
Because we do have to, if you're going to keep it, then we have to figure out the debt ratios
on the
for both properties and make sure that you qualify.
On the other side.
Yeah, based on both of them. Good question. Thanks for texting that into 77031. You too can join the party.
Kevin from Missouri wants us to know that no, LOL, not on the run, just trucking.
All right.
And love the show.
Do you believe him?
I do.
Okay, good. Me too. Fritz?
Well, we have to consider the source here.
Right?
I'm not saying Kevin's not, a fine, upstanding citizen, but that's like saying, hey, you can trust me, honest.
Right.
My name's Kevin.
Look at this face. Here's a question. If my mom has a VA loan with a 3.5% rate, should she refi?
I think a 3.5 rate is pretty good in today's marketplace.
VA loan.
Yeah, on a VA loan. I mean, you could get a little lower. You might be able to get, like on a VA loan, you can still get down into the twos. If you're well qualified, you might be able to get 2.75-ish, 2.875 in that range. But unless it's a pretty big VA loan, it's not going to save you much money. Let's say you owe $200,000, getting it down a half a point, it's only going to save you, it'll be less than $100 a month. It'll be $70-$80 a month. The only other consideration I would do is if you were thinking about going down to a 15-year loan and maybe shaving off 5 or 10 or more years off of the mortgage, that might be worthwhile because you can get those loans down into the low twos. And anytime you can shave off some years of payments, that makes a big difference. If her payment is $1,000 a month and she shaves off 5 years of payments, that's 60 months. That's 60,000 saved. So you may not, in that case, get the payment down a whole lot, but you might be able to shave off 60 grand or 100. I've seen people shorten from a 30-year or let's say a 28-year down to a 10-year, and you can save literally $100,000 plus by doing that in pure interest.
Pat from Titusville says, interest rate to lock or not to lock? That is the question.
Is the question.
Is it the question? I close on November 15th. It's not locked yet. When do I lock? I'm buying a condo in Titusville.
Yeah, I would.
Congratulations.
Lock that.
Yesterday.
Yeah, I would lock that. If you'd have locked it 3 weeks ago, you'd have been in a better place than you're going to be right now. And we're only seeing a slow, steady incline over the last 3 or 4 weeks. The other thing I would tell you is when I submit loans for my clients, I always lock them immediately. There's no reason for us anyway to float a loan and leave it out there. It only leaves the client exposed to potential risk if the rates go up.
One day in the market gets weird.
Yeah, it can happen. I've seen it, where something bad happens in stocks or something economic happens or something happens on the other side of the world.
Something happens in the world.
Right now, oil prices are skyrocketing. There's a lot of indicators that there's some instability where the infrastructure bill's up in the air. There's all kinds of things. The debt ceiling, all of that stuff is throwing instability into the markets. I would have locked, 3 weeks ago, a month ago, if it was possible. But when I submit my clients to the processing department, I always lock their loans immediately. And then, people say, well, what if the rates go down? That's not a problem for us, because if the rates go down, we can do a float down and get you down to whatever the market is. But that ain't going to happen right now. I'm looking at the marketplace, and we're not seeing any signs of any drops anywhere. From what the Fed's saying, from what's happening in Washington, everywhere. But long answer to a short question: lock it. I would lock it now.
Lock it. Lock it up.
I wish you'd have locked it a month ago, but you don't have a time machine, so you can fix that on. I would. Let me take that back. I probably wouldn't lock Monday. I don't like to lock on Mondays.
Why is that?
It's just that the market is kind of sticking its toe in the water on Mondays to see what's going to happen. So a lot of times when they come out, they don't have all the data of what's going to happen for the rest of the day on Monday. Tuesday to me is usually a better day to lock. I try not to lock on Mondays and Fridays because when you're going into the weekend, a lot of times the financial markets will kind of shore things up for the weekend in case something happens, on the other side of the world or here, as far as world geopolitics or a war or something like that. So they'll kind of shore things up a little bit. So typically from what I see, rates tend to be a skosh better in the middle of the week than on the Monday. So talk to your person and tell them you want to lock your loan, though.
Lock my loan.
If they push back on you, then maybe they don't have that policy where they can do the float down. But still, the only one at risk is you. If that rate goes up and it's not locked, it doesn't cost them anything. It costs you money.
Hey, also, if they're not locked, they can always change where they go anyway.
Yeah, absolutely.
Even if they are locked.
If you have enough time, if you leave yourself enough time, yeah. You can ask your questions at 77031. You're listening to Home Loans Radio. Text those in to us, and we will answer them live on air. Yes, good morning. We are here. It is a live show. We're here doing what we do.
Hey, MJ. Hey, Don.
Hey, Fritz.
Hey,
what's going on over there?
Oh, just sitting by this big board. Lots of pretty buttons. I might click a
Push some.
Let's see.
Push some. Let's see what happens.
See what this one does. No.
Hello?
Wait, no.
Hello?
No. Wait, no.
These are not good buttons.
And it's not good radio.
No, Jeff says, would you do a loan for land we buy in Tennessee? We recently refinanced our current home with you. Would you, do you do that?
I am licensed in Florida, so I can't do a Tennessee loan. We might be able to facilitate through my parent company, Christensen Financial, but the land loan is problematic. There's not a lot of companies doing land loans like from out of state or to another state. 9 times out of 10, when you're able to get a land loan, it's going to be a local bank or a local credit union that knows that area, that's more of a local knowledge kind of thing. So you're going to want to talk to a bank that's there, the local credit union that's, a couple miles away from wherever that land is. And they're going to be your best bet because someone here in Florida, they don't know what is prime land in Chattanooga. You're going to want to talk to a bank that is right there, and they'll look at it and say, oh yeah, that's a good place. That's going to be an up and coming place. And then they'll be willing to lend on it. Lend on land.
Land ho.
Lend. Yes.
Land ho.
Congratulations. You're listening to Home Loans Radio. You can also text in to 77031 and just tell MJ what the heck you're doing out there.
What are you doing out there? What are you doing out there?
What are you doing?
Oh, well, JB did text in to tell us that he is listening to us, listening to y'all's show and swabbing the decks and mopping the floor.
Nice. JB's out there listening. He listens all the time. But did you add the accent, or was that somehow?
I just felt it.
You felt it?
I felt it. I mean, when he wrote the words with that inflection.
Okay. Yeah, there's no scene direction. It's not like a script on this text. So.
Man comes on to microphone with Southern accent.
We start our scene in media res.
JB also asked, are we to set our clocks back in November?
Fritz?
That's a good question. Yes.
I'm throwing that one to you. That's not a mortgage question. That's
Spring forward, fall back. Yep. That's generally the rule.
Mm-hmm. It's fall back, but it's usually like the first weekend after the end of October, right? I don't know. I'd have to look it up.
Here's a question. We want to do
research on it.
All right.
Do it. We want to do an addition on our home. What kind of loan can we get? Do we get? What kind of loan does that?
Sunday, November 7th.
Okay, there you go.
Thank
question posed, question answered. MJ posed another question, but I am not going to answer it.
Oh, fine.
Because you're listening to Home Loans Radio, and we're coming up on our break here. So I want to give that question its full due. No short shrift.
Stand by, questioner.
We're going to take a break. We'll be right back.
Hey, this is Ryan from the Monsters, and now back to That Mortgage Guy Don on Real Radio.
That's right. If you have a question, text it in 77031. That number again, 77031. Save it. We love when you text us and ask us all about mortgages and rent and when should you buy, when should you sell. You're listening to Home Loans Radio. I'm Fritz. We got MJ and That Mortgage Guy Don.
Welcome back, everybody. Welcome to Home Loans Radio. As the man said, you can ask questions about that, or you can just, what, MJ?
Tell us what you're doing. We'd like to know.
Yeah. Keep it decent.
Well, the question on the floor is,
Yes.
We want to do an addition on our home. What kind of loan do we get for that?
Well, if you have enough equity, you can do a cash out home loan and work on doing an improvement, or an addition to your home. You'd have to have some equity. Basically, you're going to be, whether you're doing it through a mortgage loan or home equity line of credit or what have you, you're going to be kind of capped at about 80% of the value of the home. So let's say the home is worth $400,000 and you owe $100,000 on your current mortgage, then you would apply to do a cash out loan, and you could go up to $320,000, and that would pay off your existing $100,000 loan and minus closing costs, give you the rest of that cash in your hand at closing or in your bank account. Typically going to be wired there, and that's about a 30-day process. Normally you have to get the home appraised, and of course you have to qualify for the higher loan amount, but that's about it. It's pretty much a traditional, straightforward cash out refinance loan. There's two types of main refinances that you do. One is a cash out loan, and one is a rate and term loan. A rate and term loan would be if you just wanted to refinance whatever balance you had down to a lower rate, or maybe you've got 25 years left and you want to take it down to a 10-year loan to pay it off sooner. Then that's a rate and term refinance. If you're taking out any cash or you're paying off a home equity line or something like that, then that's a cash out loan. The difference being that the cash out loans have slightly higher interest rates, maybe an eighth of a point, quarter point higher for cash out, depending on your credit score and what percentage of the equity you're withdrawing from the house.
So do you get the benefit of the improvement you're going to make at any time?
Not on that kind of loan. That's a straightforward cash out loan. They're going to go by the value of what it is right now. And there are loans that you may be able to get that are home improvement loans where you can look at the future value of the property. But those, again, we talk about this so many times, that different programs that were kind of shut down during COVID. Okay. And for the most part, I haven't checked in a couple of weeks, but for the most part, the home improvement loans that are based on future value are and sometimes they call them rehab loans, things like that. Those are non-existent for us anyway at this point.
So if you take the loan out, you get your cash out, you do your addition, then can you refinance the whole thing for what the home is worth now that now it has the benefit of the addition?
You could, but I'm not sure I would see the value in that.
I see.
Because
the cost associated.
But yeah, you'd have closing costs again, and your rate is not going to be that much different than what you have. You'd end up you'd refinance, and you'd have a bigger loan than what you have now. So I don't think that would make a lot of sense. There could be some sort of isolated case where it would. I have to think on it, but on the surface, I don't think that would make financial sense.
All right. Flats Fisherman is listening. Thanks, Flats Fisherman.
Hey, Flats.
Is that his first name, Flats?
I don't know. That I'm interested. Or does he just fish on the flats?
No, that's Mr. Fisherman, don't you know?
The Gordon's Fisherman? I don't know. No, I don't know. That's the only fisherman I know.
From the family Fisher.
Yeah, yes. Yeah. Here's someone who's asking, how do I add my wife to my home loan title? Home loan and title. So they're two different things.
Chase doing a visual of a / to me with her arm. So I'll throw that in one more time with the question.
How do I add my wife to my home loan / title?
Well, it's typically difficult to just add someone to the existing mortgage that you have. That's kind of unusual. I don't see that done very often. Maybe if you have a private loan or a private mortgage, something like that, you could do it, but it ends up being a new mortgage. So to add someone to the mortgage, you're going to have